Welcome back to Good Day Orlando. In the consumer corner, get ready for a Fed rate hike. The Federal Reserve decided to raise interest rates, and while it's not by a lot, it does have a domino effect across the economy. Certified financial planner Bert joining us this morning to talk more about it. Good morning, Aaron. Nice to see you.
Nice to see you as well.
So let's talk about this. How does this really affect the average consumer?
Well, in the short term, really what you're going to see are those adjustable rate type things that are tied to adjustable rate, like credit cards. Credit card interest rates are going to start going up. Now, credit card interest rates are high to begin with.
Yeah, right.
So a little bump in your credit card interest rate probably isn't going to make a big difference. However, adjustable rate mortgages, you're going to start to see those payments start to go up. And when you see a little bit on a big amount of money, then it starts to add up to dollars.
Yeah, let's talk about those home mortgages first. When it comes to refinancing, are we a little late in the game at this point?
Well, rates are still at historic lows. I mean, yes, they are starting to go up. It would have been better to do this about 6 months ago if you were looking to refinance into a fixed rate mortgage. But if you can afford to do it, you really ought to lock in something, especially if you're going to be in that house for the long term.
Okay, you mentioned credit cards. A little bit more info on the credit cards. Like you mentioned, these interest rates are already pretty sky high.
Yes, credit card interest rates the banks are needed to make money somehow because rates have been so low they haven't been able to really charge you for a lot of these loans. So they've been making money on the credit cards. Bumping up the interest rate on a credit card a little bit isn't really going to make a big difference to the average consumer. Hopefully you're paying your credit cards off every month.
Right, ideally.
Yes, yeah. But those rates are still going to continue to rise as interest rates continue to go up. Now they're talking about 2 more rate hikes this year, so that you got to plan for that those rates are going to continue to go. So adjustable rate stuff is kind of scary right now.
Okay, so pace yourself when it comes to using those credit cards. Best advice. All right, what about the positive effect on savings? Because oftentimes we hear, well, if the interest rates are hiked, then maybe that's a benefit for our retirement accounts.
Yes, well, savings rates are going to start to go up. Unfortunately, because rates have been low for so long, the banks really haven't been making much money. So they're going to charge you more on their loans and not give you so much savings, and eventually competition will make those rates start to go up, but it's going to lag. It's not as instantaneous as the variable rate mortgages.
Okay, so the CDs and those long-term savings plans, maybe beneficial.
Maybe a little bit, but I wouldn't count on it. Not like,
okay.
Yeah, I wouldn't count on it.
Don't plan on retiring on all of that
not just yet. Yep.
Okay, very good. Well, where can people find you?
You can find us at financialgroup.com. Look us up, financialgroup.com. We're on Twitter, we're on Facebook, we're on LinkedIn, we're everywhere.
Aaron, always good to see you.
Good to see you as well.
Thank you so much. So just get prepared, folks. It is coming.